Gold has long been considered a safe haven asset, a hedge against inflation, and a store of value during economic uncertainty. Over the past 20 years, its performance has been remarkable, outpacing even major stock indices like the S&P 500. Recently, gold prices surpassed $3,000 per ounce, delivering higher returns than the S&P 500. With projections suggesting it could reach $5,000 per ounce by 2030, investors are now evaluating gold as a key part of their portfolios. Gold's performance over the last 2 decades. Over the past 20 years, gold has undergone significant price appreciation, driven by multiple economic and geopolitical factors. 1. Early 2000s to 2011, the golden boom. At the turn of the century, gold was trading below $300 per ounce. The 2008 financial crisis spurred a rush towards safe haven assets, pushing gold to $1,900 per ounce in 2011. Investors sought gold as protection against economic collapse and declining interest rates. 2. 2011 to 2015, price correction. As economic recovery strengthened and the US dollar gained value, gold prices declined to $1,050 per ounce in 2015. However, gold still remained an attractive asset during periods of inflation and uncertainty. 3. 2016 to 2020, steady growth and COVID-19 spike. Between 2016 and 2019, gold rebounded to $1,500 per ounce, supported by global trade tensions and central bank policies. During the COVID-19 pandemic in 2020, gold surged past $2,000 per ounce for the first time, as investors sought protection from economic instability. 4. 2021 to 2024, breaking the $3,000 barrier. Post-pandemic inflation and geopolitical tensions, e.g., the Russia-Ukraine conflict, led to increased demand for gold. Gold recently surpassed $3,000 per ounce, outperforming the S&P 500 in terms of annualized returns. Why gold outperformed the S&P 500? Gold's recent rally has outpaced the S&P 500 due to several key reasons. Inflation hedge. Rising inflation and interest rate fluctuations have made gold an attractive asset for preserving wealth. Geopolitical uncertainty. Global conflicts and economic instability have driven demand for gold as a safe haven asset. Central bank demand. Many central banks, particularly in emerging markets, have been accumulating gold reserves to reduce reliance on the US dollar. Weakening US dollar. A declining dollar often boosts gold prices, as it becomes cheaper for foreign investors. Future outlook, $5,000 gold by 2030. With gold's recent strong performance, analysts are now predicting that prices could soar to $5,000 per ounce by 2030. Several factors support this projection. 1. Continued inflation and debt concerns. Governments worldwide are increasing debt spending, leading to long-term inflation risks. Gold's role as a hedge against inflation will likely drive demand. 2. Central bank accumulation. Countries like China, India, and Russia are increasing gold reserves to diversify away from the US dollar. This trend is expected to continue, supporting higher gold prices. 3. Supply constraints and mining challenges. Gold mining output has been declining, while demand remains high. Limited new discoveries and rising production costs could push prices higher. 4. Economic and political instability. Uncertainty around global trade policies, interest rate shifts, and potential recessions may keep investors flocking to gold. Conclusion. Gold has demonstrated superior returns over the past 20 years, outperforming the S&P 500 in recent years. As inflation, geopolitical risks, and central bank policies continue to shape global markets, gold remains a strong investment choice. With forecasts suggesting a price of $5,000 per ounce by 2030, investors looking for stability and long-term value should consider increasing their exposure to gold in their portfolios.